I want to see silver bleed out. It's just temporary. If you're a buy and hold investor, you can ride it out. You're used to this anyway. Here's the thing. I feel like if it drops to like that $39, $40 range, it is a very significant level. It will be very, very short-lived, meaning you better be ready. You better have your account funded. You better have whoever you're going to call on speed dial, right, to buy physical gold, or you just jump into an ETF intraday. And we use Fibonacci retracement. This is telling us, based on the run up, what are the levels where gold should pull back naturally that is still bullish. And that sweet spot is between the 38% and the 50% correction, which happens to be 3,300 an ounce up to 3,800 an ounce. In a perfect world, we see gold roughly hit, between 8,000 and 8,500. Silver, if it was to turn around and find a bottom, right where it is today, the upside target is 123, which is a double top. And then we've got 165 is the next upside targets. When prices are collapsing, all of the places that buy physical metal stop buying. They all put a hold on. They say there's too much volatility. We're done.
We'll get to silver in a second, but so curious on the gold chart. So gold's trading below its 200 moving day average. I'm curious what are you seeing on the RSI? Like, is it oversold at this point? Just people may be wondering, like, okay, obviously, if gold drops to 3,600, I'm gonna be buying more. But people may be wondering if gold's oversold right now. Is the sentiment too low? It is trading below a lot of the moving averages and such. And so, curious in your thoughts there.
Yeah. So, it really depends on your time frame. Like saying oversold, I would say today gold is oversold on a swing trading perspective or a momentum trading. It's kind of just poked to a new low yesterday. It's oversold. It could bounce, but that is like over a 1 to 3 day window. It might have a tiny little technical bounce. Overall, I think oversold, I think is going to be that 3,600 mark. When we see this red continue to extend all the way down to about 3,600, that to me will be like, okay, now it's oversold. It's also at a technical target using Fibonacci extension. It's also going to be entering into this phase right here, into this support level as well. So it'll come down into this area. So that to me, 3,600 is going to be a very good point to re-enter. If we get here, that is when I'm going to be looking to move in, because more or less I can buy in at a sharp discount.
Markets may look weak today, but the real danger is mistaking a temporary bounce for a lasting bottom. Chris Vermeulen notes that short-term oversold conditions can trap impatient buyers, while the larger technical structure still points toward deeper support near $3,600. Institutions often wait for broader capitulation instead of chasing every rebound, while retail investors exhaust cash too early. Next, Chris Vermeulen exposes why a powerful rally can begin only after sentiment reaches its most uncomfortable extreme.
And then, of course, the next move up in gold potentially is about 8,600. Depending where it bottoms, it's about 8,000 to 8,600 an ounce, which is lots of upside. It's a pretty easy double from 3,600. And so that's what I'm looking for in the precious metal space. And so as a long-term investor, this 3,600 to me is like the sweet spot. That is the oversold. But if you're a short-term trader playing these bounces, then it is a very different story, right? Right now, as a short-term trader, I would say this here is an oversold level. This here is an oversold level. One of these was an oversold level. It's usually when you have a big red bar that's stretching down. Now, this one recovered by the end of the day, but down when this would have been an all red bar. It's these long extensions where there's elevated volume. Usually that's when people are panicking. That's when they're short-term oversold, and you get these knee-jerk reaction bounces. But they only last for like 2 or 3 days. And that's the key, is what time frame are you trading?
Mm-hmm. Okay. And having this conversation, you were on the show. You came to the conference, you're like, hey, this is very euphoric and everything. And you were warning people like gold's going to sell off, and just being here today, seeing that happening.
The biggest portfolio mistakes rarely happen during crashes. They happen when investors confuse trading signals with investment decisions. According to Chris Vermeulen, sharp oversold readings can produce fast relief rallies that last only days, not months. Wall Street desks understand that distinction, while many savers mistake technical rebounds for a new bull market and commit capital too aggressively. Next, Chris Vermeulen reveals why long-term opportunity often arrives only after short-term optimism has completely disappeared.
It's like, hey, Chris was spot on, with this with this coming to fruition. And so, I'm thinking about like the longer term. So some investors are thinking about the longer term. They're thinking about gold should be at 10,000. You have all these bullish calls, debt and deficits, so many different fundamental reasons of why gold should be higher. And so what is the possible upside, once we hit that downside target of 3,600, or even if it reverses now? What are you seeing there?
Yeah, so if we take a look at gold, so the most bullish case that I have on gold right now is simply taking the low from 2015 when we had the super cycle low in gold. It's now had this huge rally up to this peak. And if gold was to find a bottom right here, we can gauge where that upside is, right? So that is about 85, 8,600 per ounce. Now, obviously, if gold pulls back to 3,600, if I pull this pullback down, it obviously pulls those targets down. So in a perfect world, we see gold roughly hit, between 8,000 and 8,500 over the next couple of years. We see a pullback, it builds a launch pad, a base, turns around and screams higher. So that is the most bullish case that I have. We could look at a closer, more higher momentum play, saying, okay, let me just grab this tool.
That was a huge move when you look at all those green candles.
The market rarely launches its biggest advances directly from record optimism. It usually pauses long enough to shake out late buyers first. What Chris Vermeulen is highlighting is that even an extremely bullish long-term target becomes healthier after a meaningful reset rather than an uninterrupted climb. That challenges the popular narrative that every dip must be bought immediately. Patient investors preserve both capital and conviction, while emotional traders often chase momentum at exactly the wrong time. Next, Chris Vermeulen unravels why multiple timeframes are quietly pointing toward the same destination despite today's fear.
Right there.
Yeah, it's a huge move. If we look at the most recent where it rallied up, it's having this initial pullback. Even the most kind of recent move almost has the exact same target. So depending where we step back, multiple time frames, like a 10-year cycle versus a 2-year cycle, both of them are pointing to the same price. And so that gives me conviction. When you have multiple time frames saying, hey, they got the same targets, the same type of potential, that is likely, where they're going to go. The flip side of that is also where is the downside? If we go from the super cycle low and we use Fibonacci retracement, this is telling us, based on the run up, what are the levels where gold should pull back naturally that is still bullish? And that sweet spot is between the 38% and the 50% correction. So that is this blue box, which happens to be 3,300 an ounce up to 3,800 an ounce. So based on the long-term upside targets, we have confirmation that those are where we're going to run into some ceilings when we get there. Based on the short-term daily charts and the downward momentum, it's saying we should see gold pull back to 3,800 all the way down to about 3,300. So obviously, trading and technical analysis, investing, it's part science. It's part science, part skill. You have to analyze everything. It's a range. Everybody always wants, tell me exactly what to do and what price do I buy and where do I put my stop? But everything's kind of, blurry.
Everyone wants one perfect entry price, yet markets almost never reward that kind of certainty. Chris Vermeulen's argument suggests that overlapping technical signals matter far more than any single forecast, because independent timeframes reaching similar conclusions strengthen the probability of a major turning zone. The financial media loves precise predictions because they generate headlines, but professional investors usually work with probabilities and ranges instead. Next, Chris Vermeulen reveals why accepting uncertainty may actually improve long-term investment performance.
You have to give wiggle room. You've got to give a range. And so I would expect gold to come down to 33 to 3,600. And then we're looking at, 3,400 up to about 8,000 and change going forward. So that's what a long-term investor should have their mindset set at. And if it drops down into this range, to me, that is the part where you accumulate, right? You start stacking or getting close to that level right now.
Yep. And and that level's higher than where it was. I mean, depending on how long folks have been buying the metal.
Yeah.
So let's pivot to silver. I know you mentioned you had these huge silver bars and stuff, and then I remember when silver was making parabolic highs, you like, I'm selling this stuff, like, so silver's taken out to the woodshed. I mean, look at that huge red candle there. So yeah, what's going on here?
Yeah. So, I mean, it was funny because I bought 2 1 ounce, I had 3 1 ounce silver bars. And I remember buying them, and I told my wife, I'm like, when 1 silver bar is worth the price of our first house, I said, I'm selling it. That was my logic, right? Super savvy. And so it did. We literally saw 1 silver bar, 1,000 silver was the price of our first house. And it also just happened to fall in line with the parabolic spike with we had a silver target at, I think it was 106.
The smartest exits usually feel uncomfortable because euphoria convinces almost everyone that prices can only keep rising. This is where Chris Vermeulen's thesis shifts from prediction to disciplined execution by emphasizing predefined targets instead of emotional decisions. Institutional investors frequently lock in gains while headlines remain overwhelmingly bullish, leaving retail participants to chase the final stage of the move. Next, Chris Vermeulen exposes why silver's recent collapse could be creating the foundation for its next major advance.
They said if we get to 106, we're going to see like a blow-off move, which we did. It hit 106 and then it spiked up to 118, 119. And all of that happened at the same time. The bar became the price of our first house. So I did. I liquidated all the silver, moved out of everything. And now it has reversed and we've got, it's suffering pretty good. When we look at this chart pattern, we can look at the upside target first. We can look at the spike low that we had back in COVID. We can look at this giant parabolic peak and where silver is right now. It is telling us that, based on the current price action, silver, if it was to turn around and find a bottom, right where it is today, the upside target is 123, which is a double top. And then we've got 165 is the next upside target. So, that's pretty much where the silver chart is pointing to. I mean, we could look at the other scenario, like the most recent low that it took off, kind of like gold, where it shot higher and pulled back. If we carry it forward, it shows a bit lower target. So it's showing 115 up to about 151. So again, that's kind of showing us the upside range for silver. Now, I did have higher targets for silver. I did have 175 about a week or so ago. But overall, we broke the lows on the silver chart, and now that's starting to actually hurt the upside potential. So we broke this pivot low right here, right around 61. And so now that silver is breaking down.
Parabolic rallies don't usually end with a gentle slowdown. They often finish with violent reversals that erase confidence just as quickly as they created it. Chris Vermeulen notes that breaking an important support level changes the probability of future price targets, forcing disciplined investors to reassess rather than cling to old expectations. The market punishes stubbornness far more often than temporary caution. Next, Chris Vermeulen reveals why lower prices may actually improve silver's long-term reward potential instead of destroying it.
The upside target is starting to be negated, right? This was a critical support level that is now broken. And so those are the upsides. Now, if we look at the downside for silver, using Fibonacci as well, we've got this initial downward move. We've got the bounce. And if I just bring that forward to the hard right edge here, you can see those downside moves. We've got 618 is the target, which it put in a big bounce, put in another bounce at this 618, this level right here. And now if you bounce off that level, you generally go down and you hit that 100% measured move, which again brings it right back to where the feeding frenzy, the piranhas of the precious metal market came in and just gobbled up everything and drove the market higher. So I believe silver is going to try to shake people out. and wipe out and then do the same as what gold does, right? Then it's going to try and build a base and waste a lot of time. Eventually it'll come back up and then head up towards those targets.
Is that $40 silver, that 100% measure move down?
Yeah. $39-$40. That's the 100% measured move.
That's scary right there.
I mean, depends how you look at it. I think it's golden. This is a prime opportunity, right? Like, to think of where silver is, right? We eject out at 111, we pick it up at 63, and then the next upside target is, the first target is a 200% gain, and then the next target range is somewhere around a 300% gain. I think it's the most beautiful chart ever.
A decline that terrifies the crowd often becomes the opportunity institutions quietly prepare for months in advance. According to Chris Vermeulen, a move toward the $40 region could represent the final shakeout before a much larger recovery develops over time. Investors focused only on today's losses may overlook the improving long-term risk-to-reward equation unfolding underneath the volatility. Next, Chris Vermeulen exposes why the most painful phase of a correction often creates the strongest future returns.
And I want to see silver bleed out. It's just temporary. If you're a buy and hold investor, you can ride it out. You're used to this anyway with silver, or pretty much any commodity. So let it bleed out. You can always add more. Me as an active investor who doesn't want to hold stuff going down, I just, I sell near peaks or when they're overvalued, and I buy it again later when it's ready to start another big run. So I think this is an amazing looking chart. I think people should be excited for this, to be honest.
Yeah. Agree. It depends on what side of the trade you on, but I definitely think, for me, like I sold quite a bit of my physical ounces, somewhere around on the way up. Like it was, I sold some at 60, 70, 90. I sold some at 100. And then, I started buying back, when it started getting back to 70s, not a lot, just, a few ounces here and there.
Yeah.
But yeah, I mean, if it goes down to 40, man, I'm like, wow. Like, yeah.
It's going to feel cheap. It's going to feel like, here's the thing. I feel like if it drops to like that $39-$40 range, it is a very significant level. It will be very, very short-lived, meaning you better be ready. You better have your account funded. You better have whoever you're going to call on speed dial, right, to buy physical gold, or you just jump into an ETF intraday.
The best buying opportunities usually disappear before most investors finish debating whether they're real. What Chris Vermeulen is highlighting is that deeply discounted prices may exist for only a brief window before institutional demand rapidly absorbs available supply. Investors who wait for comforting headlines often discover the market has already repriced higher. Next, Chris Vermeulen unravels why preparation matters more than prediction when panic suddenly creates extraordinary value.
And pick up your dollar value, and then you can always just move to physical later, but at least you got in with the ETF, right? Because here's the problem. When we got into or got out of silver, for example, let's just take a look, because this is really important if you're trading physical metals. So what happened here is we hit the 106 target for silver. 106 was the upside measured move that we had. And I said, if we hit 106, we're going to just see like a feeding frenzy. It's just going to like instantly kind of have this blow off phase. And then who knows where the top is, but it is going to like collapse after that. And so we sold out as it came up and hit this level. And we exited at 111 as it was screaming higher. And like, I mean, it was like, you could cut the air with a butter knife. It was so thick with sentiment and the bullishness and the excitement. I mean, it felt like silver was going up 5% every day. It was freaking unbelievable. I haven't felt that in a long time. And so what I did is I sold into the strength. And then as other people who follow my work and members, a lot of them didn't. And then as it started to fall and collapse a few days later, they would try to sell their metals, and none of the metal places would take them because there is too much volatility. When prices are collapsing, all of the places that buy physical metal stop buying. They all put a hold on. They say there's too much volatility. We're done. And so a lot of people who waited couldn't get out, and they got out, down in the 70s.
Retail investors often assume physical precious metals trade as smoothly as stocks until extreme volatility proves otherwise. Chris Vermeulen's argument suggests liquidity risk becomes just as important as price risk, because dealers can temporarily stop accepting orders during violent market swings. That hidden constraint rarely appears in mainstream discussions, yet it can dramatically change execution when emotions peak. Next, Chris Vermeulen reveals why understanding market plumbing can matter more than correctly predicting the price itself.
Range. And so that is what could happen potentially over here. I think it'll be.
They probably got offered lower than where it was in
well, they couldn't even sell it. I had a lot of people. We had dozens of people saying, "Chris, I'm selling at the same spot you did, and they're not taking my order." They said they're done for the day and done for the week until volatility changes, right? And so my fear is, and the reason I bring this up is, we're going to see a very, very potential sharp drop into this, and potentially as it's dropping, there is potentially you'll be able to buy it, and. Or you might need to wait. So I don't know how it'll be when the market drops into a support level. I think it was different in this scenario. I do feel like because it popped and dropped so quickly over here, they froze a lot of people buying physical metals. I'm not sure how that'll fall into place if it does the same over here, but overall, you got to be ready to pick up. And if you can't buy the physical when it spikes down for, say, 1 or 2 days, you might just need to buy the ETF. And the ETF will rebound as silver and gold rebound right away. And then you can buy the physical metal at a higher price later, but you actually kind of bought it already, with the ETF. So you're just changing from an ETF over to a physical. So you might have to do a little bit of a song and dance here to actually get physical metal valued kind of, at a spike low. That's where I think people need to understand.
The greatest investment risk isn't always being wrong about price. It can be losing excess precisely when opportunity arrives. This is where Chris Vermeulen's thesis shifts from chart analysis to execution, by warning that physical markets may temporarily seize up during panic-driven moves. Investors with flexible strategies could secure exposure, while others wait for dealer restrictions to ease.